Greetings, Dr. Jeffrey Scott here. This is my weekend market update for the week ending on Sunday, July 21st, 2024. Now, a couple things hit me when I put this up here. One, thank God today's still Saturday because July 21st is my anniversary with this lovely lady on the left. That picture was taken at one of my medical director's marriages or wedding in Costa Rica about a month and a half ago. I've had some surgery since then, so I bet my gut is less, but she's still just as beautiful as the day I married her 39 years ago. So the best part about doing this on Saturday is I still have time to go get a card and a present so I don't look like an idiot. Although I was going to pull the I just had surgery card if I had to. I title this Markets Pullback from Historic Condition. You might be wondering what that historic condition is. Well, I sent a news alert, a email alert to a number of people on a small list I keep on Tuesday and basically warning them of something that was unprecedented, and I'll show you that in just a short while. Again, my name is Jeffrey Scott. My email address is hgsidoc@gmail.com. I will respond to emails. I appreciate constructive criticism, positive or negative, to make these better for you. I don't do this to sell you anything. I do this because I've got tools out there in the market that people have bought, whether in Wealth Charts, TradeStation, TradingView, and I want to show you how I use them so you can get something out of them perhaps as well. I don't like the fact that I have tools that I bought that I never use, and I don't want to be that guy selling them to you. Disclaimer, as with everything I do, this is for educational purposes only. Anything I talk about is a spirit of education and not investment advice. I'm a doctor, not a broker. I'm independent. I pay for the tools that I use. I don't have any ongoing paid services that I sell to anybody. I just like to trade, and I like to show people what I do. And trading involves risk, and you are solely responsible for any investment decisions you make. Well, thanks to those that joined me on Friday, Crowdstrike Friday, for the Wealth 365 event at 9 a.m. I had a good time looking at the markets. And for those that like things like this video, I do most nights, especially when I'm not on the road, I will do a video sometime between market close and then the subsequent market open, sort of what I'm looking forward to in the next day. I try to keep them to 5 to 10 minutes long. Not a replacement from owning your own tools and software, but again, a daily attempt to teach you how I see the market and how I use the tools. Major markets. So was it a bad week or a good week? Well, if you're a big technology person, boy, it was a bad week. You see NASDAQ down 3.6, the Q's down 4. The Russell, which, yeah, it eased at the end of the week, was up 1.7%. And interestingly, notice the Russell's only 4.3% off its 52-week highs. A little bit deceiving in that it's the only one that hasn't recently hit new all-time highs. Those are back at the end of 2021. NYSE was down half on the week, really turned negative on Saturday. The spiders, like the NASDAQ, had a tough time. We're down 2%. Strength in the market was Bitcoin. You can see the GBTC was up 16%. I think a lot of people thought that the recent sell-off in Bitcoin was going to continue, and perhaps a few people were caught positioned the wrong way. The dollar turned up 0.5%. ARC Innovation was down 0.3. Other key things that I look at here, IBD 50 was down 4.7%. A non-leveraged ETF based upon the published list of the IBD 50. To me, this is not saying that the IBD 50 is a bad list. I mean, I love the IBD 50. I've been a subscriber to investors.com forever. But what it's telling me is that small cap growth are not in favor. And you could see natural gas continues to drive us to the bottom. So the other thing to point out, and I showed this maybe the last week, is look at the Russell off of its lows, which were in October 23, up 34%. And that's a pretty big move. In fact, when you look at the performance off the 52-week lows, the Russell's actually only trailing the NASDAQ and the Q. So isn't that interesting how quickly this reversal of this big versus little market. If you look at what worked on the sectors, energy, real estate, financials, and staples, a little bit more defensive appearing than what we've been, with the laggards being technology, discretionary, and communications. I guess utilities lagged because perhaps rates concerns. But tough market in the week, and this was one of those markets where you got teased on Monday and Tuesday. In fact, if you look at the Cube market breadth tools, you could see we ended the week Friday with all the sectors down. This is looking at the S&P 1500, so you have to think about that differently than the 500 because it includes the 500 large cap, the 400 mid caps, and the 600 small caps. 83% of industries were down and 71% of stocks were down. So it was a tough session. If you look at over the last 2 days, really tough. All the sectors down, 94% of the industry groups, and 87% of the stocks. What's remarkable, though, is if you look at 5 days, it's a whole different picture. So was this just a short-term pullback, and is the market going to pause a little bit and then start to rally? Or is there something more ominous here? I mean, there's a lot of reasons to be concerned. Weak part of the year from a seasonality perspective. We've got an election coming up, so a lot of people like Trump policies. A lot of people don't. But there's also an element of wild card with Trump, as we saw when he questioned who pays for the defense of Taiwan and why do we have so much of our semiconductors produced over there. It's going to be an interesting couple of weeks, couple of months. And typically this is a relatively weak time in the markets from a seasonality perspective when you look at the presidential cycle, this year in the presidential cycle. Market breadth, this was the Q Edge. It's a tool from Sagar Nandi, superiorprofit.co, and powered by Metastock Data. This is his market breadth tool. And, it shows me things like Bangos, which is irrational exuberance. It shows me the Hindenburg omens. And one of the things I really like, this here is the total view. It combines the NYSE and the NASDAQ. So it gives me a very broad market look. But you see this light blue line? It will correspond with peaks in the market. When it hits the bottom, it's typically valleys in the market. We were very overbought by this 3-month new high, new low. That is no longer the case. You could see we had a period of time where small caps were outperforming and value was outperforming, but now we're sort of in indecision. If we look at the NASDAQ on the left and the NYSE on the right, they both sold off. We'll see if the 50-day holds on both of these. We'll look at this further. But notice how much the 3-month new high, new lows came down. And in fact, if I look at the Dow, the Russell, the NASDAQ, the 1500, and the 500, I was nervous on Wednesday and Thursday that even though the market started to soften, these things had not budged off of overbought territory. And they've now all come down to where it might be telling me that soon I'll be able to buy again. This is the Nick Drendel tool. I like looking at it. Gives me some information. ARC did finish positive on Friday. We said the small caps were bigger in the middle of its range. For the most part, the indices were down, finishing in the lower part of the range, which is not great. If you look at what led the markets higher, cryptocurrency. So a lot of the derivatives like Riot, Mara, BIT, MicroStrategy were up, plus the GBD, Global Bitcoin Trust, GBDT, I think it is. But you could see on Friday, most of the industry groups were negative. And if you look at the week, they're still mostly red. Home builders, driven by some positive earnings, but also by the lower rates. Crypto, as I mentioned, were the big leaders. Energy, not so bad, as well as financials. So when I look underneath, the rates were up just a bit on the week after several weeks of falling. You could see the falling. Hope this turns out to be a lower high, and that maybe we'll get a lower low and show us that we're going into a downtrend. But this, for 1 week, the rates were up, markets were down, because of economic data, it seems like there's almost a pricing in of 100% certainty of a rate cut in September. Let me ask you this question. If you're Jay Powell, who's supposedly independent, so I'm not questioning that, and you think your next boss is Donald Trump, and you know Donald Trump will look very down low at the Fed if they cut rates before the election because that could be seen as trying to stimulate the economy and helping the incumbents. Um, You'll have to answer to the Donald if he wins. So I don't know if it's a slam dunk as everybody thinks. I sure hope so. I don't think markets bottom until rates actually start falling. Now, what about recession? One of the things that's driving this concern on rates is concern that the economy might be slowing faster than people think. Now, I show this every week. I think concerns are growing. I still don't see it as imminent. You'll notice on the top is the 10 minus 3 months, the 10 minus 2 years. How do we know the yield curve is inverted? Because this black line is the zero line. And you can see on both there is inversion. Notice on the 10 minus 2 year, we're getting closer and closer, but we've been here before, and it has turned back and went lower. You can see what happened here on the 10 minus 3 months. These gray bars represent recessions. To my eyes, you get recessions after you cross back above the zero line. And to my eyes, every time you drop below the zero line, you're ultimately going to get a recession. So yeah, we're going to have one. Maybe it's closer here, and I think it's something that's worth bearing out and watching. Now, going against it, we're not seeing any evidence of credit tightness here in the BOA high yield index option adjusted spread. And on the Philadelphia diffusion index, we're still seeing manufacturing. So concerns growing, absolutely something to pay attention to, absolutely. Um, and I used to show a slide that shows that bear markets in a secular bull are one thing, but bear markets in a secular bear recession period of time can be much, much worse than we've experienced. Think 2007, 2008. Now, breadth eased and didn't ease. I guess I probably should have said it eases, but I guess I'm going to say it did. You could see that stocks above the 200, stocks above the 40, relatively flat on the week. But the most important thing is, and you can't see it really well, but we spiked into record territory on Tuesday and Wednesday on the 13-week new high, new low. And notice when it came down, so did the markets. It is like clockwork. Talk about clockwork. Let's talk about the buckets. So Ian taught us a long time ago, those that were fortunate enough to know him and follow his work, that you could take the Bollinger Band, set 0 at the bottom, 100 at the top, and divide it up into 10 different buckets. On the middle is the 50-50 line. So we saw and this is for the S&P 1500, by the way, on Friday, we closed at 77% of the stocks above the midline, 23% below. That's bullish, not even excessively bullish. And then you can look at where in the Bollinger Band range are the stocks sitting. You have less than 0 would represent those below, and less than and greater than 1 those that are above. That to me, this chart for the 19th looks more bullish than bearish, and no signals. Look at where we were on the 16th, which was Tuesday. 91% of the stocks were above the midline, too hot. But more importantly, 60% of stocks in the S&P 1500, this is not just large cap, small cap, mid cap, 60% were above their Bollinger Bands. If you think that the Bollinger Bands are to capture the stock movement 90% of the time, that means only 10% divide above and below, 5% above and 5% below. Do you expect to see any evidence that the stocks are above or below the Bollinger Bands? When 60% are there at the same time, it's a problem. So I look back, I put 25 years into my tool edge rater, and I saw that Tuesday's bucket reading of 60% was the largest in the data set. To me, that is historic. 60 years, 25 years of at least 240 days of trading a year. And this is the worst one going back to the 90s. That is historic. That told me the market was going to reverse. Hence, to my email list, I sent out a concern. So was a pullback surprising? Absolutely not. I've been doing this for a long time, and I probably ought to do a slide like this for a downtrend now that I've got enough data to support that. But my point is, every time we get with a lot of stocks above, we pull back. Every time we get a lot of stocks below, we go higher. So it was what it was. Historic stretching of the markets. Hindenburg, omens, well, we had plenty of signals on both the NYSE and the NASDAQ telling us that a problem was coming. It's now come. Doesn't tell you how far it goes and whether this is it or not. It could be. So now I'm going to start watching the new highs and new lows. Interesting, the NASDAQ, the new highs have dropped a lot while there's still 2% new lows versus the NYSE where, yes, the new highs have dropped a lot, but there's no new lows. And we talked about this, I don't know if I talked about it in stocks and chart, probably my weekend, that when you start getting 14% to 20% of stocks with 52-week new highs, new lows, that you get to a point where you expect some type of a correction. So what about the whole market? So 2 days of good, 2 days of bad, 1 day of mixed. You could see here that if I take every stock in my universe, which is $2.50 and 250,000 shares, and I look at performance tied to ERG, which is EPS rank plus relative strength rank plus group rank, that you had better performance in the lower ERG stocks. So that's telling me stocks that were out of favor were actually doing better. Down here we could see the best earnings per share rank, the worst performance. The best relative strength rank, the worst performance. And the best group rank, the worst performance. That's another week of market rotation and weakness and growth. Now, those that came to my June program in Orange County, and hopefully we'll do it again next year, and if Greg or Dave are listening, we should probably come to an agreement sooner than later. I am in. If I'm alive, I'll be there. And I hope to be alive and plan on being alive. And maybe we should give people more notice than we've done in the past. But we had a great time at the meeting. I taught them how to make a leaders list and talked about that one way of knowing that this market would be done would be when a list of leaders breaks down. And what did we see here? We see that we're breaking. We haven't broken. This green line here is my chandelier stop that is trailing up this index. One of the beautiful things about HGSI is I can make synthetic indexes from whatever I want to put there. We also had a doji there, so we're right above the 50, right above the stop. I would say we're at a pretty critical junction or a decision point. A further fall would suggest to me that this market is done, and I'll be positioned to go to drop more. A bounce here will make me reconsider. Know your news and earnings. So as I think about this quarter last year, it was a horrible time in the market. If you missed, you got punished. Well, we are now getting into what I call earnings lollapalooza. This is the second big week. There's probably 2 or 3 more big weeks to come, and there's some really big names there. Whether we're looking, just start at the top. We still got regional banks. We've got Steel, Nucor, and Cliffs. We've got Alphabet and Tesla, Visa, Coke. On Wednesday, we got Chipotle off of a recent split, so you can buy it again. At least you can buy a lot of shares again. Thursday, we got some airlines still, American, Southwest. We got drugs. We got Korg, Dr. Pepper. We got Skechers. And then Friday, 3M and others. It's a judgment call to hold stocks over earnings dates. It's bad judgment to not know when your stock's earnings date is scheduled. A fair amount of news this week. We got PMIs and new home sales and GDP and jobless, but what we really got is a PCE. And that complex is something that the Fed spends a lot of time trying to determine what direction to go from a rate cut perspective. So thoughts, we limped into the weekend. Yep, rally um, stalled for small and mid caps Thursday and Friday. Mega caps got hurt on the week. The semiconductors dropped 8%. Now, is that setting up a big buying opportunity? Maybe. Um, Trump didn't help with his Taiwan comments. Um, you know, Interestingly, we held up better than I might have expected on Friday from a tech perspective with the blue screen of death. I have a healthcare tech company that I'm one of the founders and leaders of, and we're Windows based and Azure based, and Crowdstrike is one of our tools, and we woke up with the dreaded blue screen of death all over our company. Kudos to my staff, but also kudos to Microsoft and Crowdstrike. They rolled out fixes very quickly, and everybody was back up and running. Sell-off was not a surprise. I showed you the buckets and the 13-week new high, new low. So let's wait for the CPE. I'm cautious going into that. I am going to look for evidence of a bounce. We are in a seasonal weak time of year, so I see no reason to jump all in without more evidence. Look, at my buckets, if I start building up the bucket stocks below the Bollinger Bands, that'll get me excited. If that 13-week or 3-month new high, new low starts coming down to over sold areas, that'll get me excited. And then it's just the price and volume action of the markets. So I'll be looking for opportunities to get in bigger. Let's go take a look at the charts. So let me stop that. Now, I get a lot of questions from people. Well, why do I always use wealth charts on this? And I do that because they've been gracious enough to give me opportunities to speak at Wealth 365 and other events. They built my tools into Wealth 365 for everybody to use. I'm just going to reset this flow talk, and I didn't like that line there. And they've been good to me. That said, I don't sell platforms. Um, I don't really sell anything except for some indicators. I like to teach people how to trade as a hobby. I don't have a website. I don't have a place you can go pay for my education. My mailing list is kind of a growing friends and family email list that I share information with or my thoughts with. Um, and I do it all in the spirit of education and not trading advice, as we said in the beginning. So I do have stuff in TradeStation TradingView, potentially soon in Metastock and in Wealth Charts. But you pick the platforms that you like. I just want to show you how to use my tools. So Wealth Charts is probably the most widespread in this country when I talk to people, certainly big growth. I think Metastock historically has been extremely widespread, especially ex the US. But let me show you how I use wealth charts in the next 20 minutes or so to show you what I'm going to be doing in the market and what's happening. So let's start with the weekly market timing model. And let me just expand the stock to 2 years. Whoops, 1, 2, get that, one more. All right, there it is. There's the 21. Okay, let me do this here. I just want to see all the way back to 21. There we go. Let me do the same here, all the way back to 21, and then the same here. So this timing model I've been using for a long time. It includes a weighted moving average and a proprietary indicator I call the bongo that I developed with some friends years ago. And I just want to change one thing on those charts. I have used this timing signal, and it has worked for me for many years. And what it does is it tells me, let me just do that and say that, is if I'm prices above and the bond goes green, that creates a new buy signal. On the S&P, it was a week after the bottom at November 6th, and it has not gone short yet. On the Qs, and the white is the one we're looking at, the 50s in yellow, because I wanted to watch how that was tracking, and this is a weekly chart, you could see we've had a couple of short pullbacks that shook out when the bongos went red. But other than that, we've been in an uptrend, and since I think, well, this says this was January of 23, and then this here is that October or November 6th. So it's been a very good signal, even with these two pullbacks, of keeping me on the right side of the market. The NASDAQ is long as well. Excuse me, the Russell, as you see the spider and the Qs, there's nothing up here to the left. They're right off of all-time highs. The diamond set an all-time high this week, but boy, that's a shooting star if I ever saw them, a likely reversal candle. So I'll be watching how it compares to the WMA and the Bongo. And the Russell also gave kind of a shooting star. Now, the Russell's different than all the rest because you'd have to go back to 2021 to find the all-time high, and we are not there. Now, so the weekly timing model, which is my longer term direction, says it's okay to still be long in my long-term money. Doesn't mean I should be adding to it. Doesn't mean I shouldn't be nervous. It says I don't need to be out. The daily model gives me conviction, and the daily model is not so good. And the daily model, spider closed below, and the bond goes red. I was in a yield sign, and now I'm going to have to change that yield sign to a enter a short sign. So we are now in a short signal for right now on the spiders. So I'm not buying into that signal. If I look at the Qs, I've been in a short signal now for a couple of bars. If I look at the diamonds, I'm still long, and the Russell, I'm still long. So long term, I still see us going higher. I expect a correction here. We're in the midst of it, and as we go forward, I'll talk about where I think that correction is going to take us to. If I look at the indices, and let's go into the 5 minutes and let's blow that up. And this is a mess, so let me tell you what you're seeing. In fact, we do that. The candlesticks represent, let me get 5 days worth. 1, 2, 3, 4, 5. 5 days worth of the S&P. So you can see the candlesticks were relatively flat Monday, flat trending higher on Tuesday, and then Wednesday we broke down a little bit. Thursday we got hammered, and the selling continued into Friday. Now the Russell looks a little different, where the Russell actually didn't start selling off until Thursday. The mid caps, and again, the Russell also was not flat on Monday and Tuesday. The mid caps here, just like the Russell, up Monday and Tuesday, a little weaker on Wednesday. Selling started Thursday after the run up. The Qs look a lot like the spiders, flat Monday and Tuesday, and they just gave it up on Wednesday for the rest of the week. And the Dow set that all-time high early Thursday and then sold off. I think the key is that by the end of the week, everything was selling off. So there was better performance of the small caps on the week, probably because of the beginning of the week, and not certainly the end. If I look at the spiders, yes, as we just defined, the spiders, at least on the timing model I like, the spiders are in a sell signal on the daily. Now, but let's talk about where I think this might go. Let me just, I don't need to show that there. My target is down here. This is the 50. It might come up a little bit above it, but it's somewhere around the 50, and this gap fill has been my target. I've talked about it several times. We're at 548.90. The target's at 539. 10 points among friends, another 2%. Do we have, how likely is it that we hit that on Monday and Tuesday? I think it's pretty high. So, as I wonder what this market is going to do, I think, if I had to guess, as we could, I should have just turned something on. Let's see why that's not working. I guess maybe let me try this again. Well, it's not working. All right, I was trying to draw a line using a drawing tool. I'll spend more time figuring that out. So what happens from here? And I like drawing things because then I can go back and look at them. My guess is you might see a little run here, but do you come back down to this point? I would not be surprised. And even though I'm more bullish than bearish, I wouldn't be disappointed. In fact, if I just show you real quickly seasonality, and let's look at market ETFs, and let's look at the Qs here. You see the seasonality there? All right, if I look at the spider, you see the seasonality predicted when it comes on. Okay, if you look at the Russell, you see the seasonality. So why wouldn't I expect that we don't do a little bit of the same? The issue will become when I get here. Do I run to new highs? I'd love it. Or do I break down and start wondering about the 200 and this level here as my next support, maybe here and then down here? I'm still in the camp that this will be support, but I have to be aware that this could be the start of something worse. Do I think we're done going down? I think we got a couple more days. I think we have a couple more days. So that's the spiders. I could do the exact same thing on the Q, although I'm not going to, and you could see the Qs have broken through the prior Thursday low and coming right into that area of the 50 and support. I think we're going to get a clue there. If that doesn't hold, I wonder if my next area of support isn't going to be over here. So let's watch for that as well. So we are at 475. I mean, we're 1% away from tagging my target. So that's concerning. Down 0.89 on Friday. If we look at the diamonds, we had all-time high, closing high on Wednesday, hit an all-time high Thursday and closed lower. This one looks like, it's heading down. Is it going to head down to the 50? It was down 0.93. If we look at the Russell peaked on Wednesday with a shooting star on the daily coming back. Same target area in here, but in this case, the 50 is going to be below that, so we'll be watching that. The Russell on Friday was down another 0.5%. And no surprise, market's more risky. The VIX has bottomed and it's heading up. And the VIX, if we look at the week on the VIX, you can see a big move was up 32%. That should keep you a little nervous about where this market is going. And then if we look at the US dollar, it's pulled back to this 200 area. Right now it's still consolidating, but it did break above the 50. So I think that's something that I'll be watching. Higher dollar does not help the stocks. Now that dollar's higher. We had a lot of sell-offs. No surprise, gold did not hold up. Gold should do favorable if they start cutting rates. Gold was down 1.79. Silver was down 1.88. Oil was down. I don't know if this is kind of like a mass consumption down, minus 2.38. And the 10 years were actually up a bit, up 0.86. We already looked at the market timing. Breadth, one of the things that we saw over the last couple of weeks has been a resurgence in the equal weighted RSP versus the spider, the equal weighted QQE versus the Qs. Still the same instruments, just a different way of calculating the average. Personally, I think broadening out the market is good long term, and it still seems to be in process of that happening. I haven't talked much about the guppy charts, but I like looking at how prices are within the moving averages. And if this market is going to roll over, this is weekly charts, then we're going to start to see penetration of these moving averages. And if I was to flip this to daily, you could see even on the daily, we're still above the moving averages. So this keeps me still thinking the market, whether it pulls back a few percent or not here, I don't want to say irrelevant, but it's irrelevant to my thinking. I still think the market is probably going higher from here, and this is part of the evidence that I look at. Hourly sectors give me a sense of what's working in the markets, and we know that we've had reversals here. Staples started improving. Real estate still looks good. Biotech gave up some from last week, so it loses its star. Um, what else is leading? Financials, real estate, and Staples look like they're coming up, which is never a great thing because Staples is defensive. Now, sometimes I will drop this down to say 15-minute and see what was really working as we looked at the end of the day on Friday. Now, it's supposed to do everything when I do that, not just this one. Why did you not do that? Let me try that again. Try it on this guy. Probably because the whole world is on wealth charts now because it's Wealth 365. So if you look at what was happening at the end of the day on Friday, um, everything seemed to be responding and recovering, but not technology. That's interesting. Look at the end of the day. This is 15-minute charts of Staples, of real estate, of utilities, industrials. What did not biotech? Um, Interesting. All right, so then I like to go to stock scanners. Stock scanners, and we open up the NASDAQ 100, and you could see everything was red. Now, sometimes there'll be a discrepancy between what Wealth Charts does in heat maps and what other programs do. There is a very simple reason. That's because Wealth Charts keeps the open until the market after hour session around 7 closes. So it will include the after market. Not much occurs after market on Friday, but you could see a weakness. You want to see bad? Crowdstrike pulled from a leader, which was already in decline, all the way down to the 200 and it bounced. My thoughts on Crowdstrike, it maybe it bounces around here and then it goes higher. Might be a good place to start buying. We use Crowdstrike. It affected 8.5 million Windows devices worldwide. But thank God it wasn't a outside attack, and they got to get some bonus points for how quickly they fixed it. Would I buy it on Monday? No, I'm going to see if it starts to build a base there. Tesla, after a big run up, has sold off. Still seems okay, holding at the 17. Okay being a big word. It hasn't broken down. I'll leave it at that. NVIDIA come down a lot, sitting right at the 50, which we call free parking. It's often a place to pick things up on a discount, but I don't buy it because it's there. I got to see it start moving up. Apple, been a big leader, it's pulled into the 17. It's done that before, and it's been a great place to buy, but wait for it to show it's going higher. Amazon has broken down below the 50. It could be a reversal candle here, the green candle low on Friday, but let's let it evolve more. AMD has broke down all the way to the 200. Again, is this going to turn out to be a great buying point? Look what's happened off the 200 in the past. It may be, but let it give evidence of stabilization. Just don't run it because you think so. Could be right. Broadcom, I guess it's had its split. It had a 10-to-1 split. Pull back to the 50. Again, give me some positive indications before I start running in. Microsoft broke down and closed right below or at the 50. Be interesting to see if this holds here. If this market turns around, the 50 holds, that's not a bad place to start accumulating shares. Netflix, again, that's an ugly belt hold to the downside. Candle, if I had a choice of going long or short Netflix here, I'd probably be going short, but I think it's all about the market. And then Meta is one of the weaker ones down below the 50 as well. You want to see two things that looked good? We may come back to them. Starbucks. No, it's an ugly chart. Why does this look good? Well, if you like buying double bottoms in a former leader that's now 30% or more off of its highs. You had a wealth signal on Thursday. Friday, you took out the 50 on great volume. You just have to check when earnings are coming. The earnings are close. Look at relative strength, and OBV picked up. And Intuitive Surgical, not to share personal information. Most of you know I had recent surgery. The type of surgery I had, if I had it in the old days, I probably would have been in the hospital for a week, and I would have been laid up at home in bed for 2 more weeks, and I wouldn't probably go back to work for 3 months. I had that surgery 3 weeks ago yesterday. I went back to work this week. I was out of the hospital the next morning, and the difference between the old and the new is not just the surgeon's skill, it's the tool set they have. And I am now a big believer in robots and intuitive surgical. Um, Bad day in the market, it gave a great buy signal in here. Lots of volume, 4 dots. You can see the earnings the night before it beat by 15%. I used to wonder how much of it was a marketing ploy. And yeah, it's extended and that's a concern, so be careful. But boy, I'm going to be paying attention to its performance going forward and buying it when it's cheap. It's not cheap right now. S&P 500 looks like the NASDAQ 100, mostly red. And where the Russell 2000 on Wednesday still looked good, it turned red like the rest. So let's just look at the Russell 2000. And you can see more green than the others, but still has quite a bit of red in it, but definitely stronger than the NASDAQ 100 and the S&P 500. Wealth Scanner. Wealth Scanner is a tool that I use to rank things. And with Wealth Scanner, I have put together a list of ETFs, major market ETFs in the industry indexes, sectors, themes. And I like to see two things. Whoa, has it changed since Friday? How many are above 800? Well, on Friday, I had to scroll down to get to the end of the 800s. Markets significantly weakened. We got banks, we got dividends, we got home builders, we got construction, we got MLPs, which are dividends, we got more banks, and we're now below 800, folks. This market quickly deteriorated from overbought to a little bit weaker posture. So banks, dividend players, and REITs, banks and home builders, banks, dividend players, REITs. That's kind of where I would be searching for right now if I felt the need to go long. I don't feel the need to be long the market. In fact, what I said in my market thoughts, which I don't think I spent much time with, was I'm going to be cautious and look for signs of a bounce. We're in a seasonal weak time year, so I see no reason to jump all in without more evidence. I'd like to see more evidence. You can look at KBE, some of the big banks, Bank of America, although they announced Buffett took some profit taking. I don't know if that'll do anything to the stock on Monday. His sales are already done. Big run up. Dividend players, big run up, a little bit of an ease on Thursday and Friday. And home builders, big run ups. Those are really the strength in the market right now. MLPs are big dividend payers, and I have one which I've talked about multiple times. I've had, and I don't know why I never even looked at, I don't trade in and out of it. I just collect a nice fat dividend, but it's Energy Transfer. Yes, it's a MLP, it's a K1 MLP thing, but when you can get price performance and dividends, it's a nice thing. So now I want to look and see if there's anything interesting in the market to the long side or short side. So let's take a look at my combo leaders list because it's fresh, put together of stocks that fundamental, technical, various people put them on lists that they thought were interesting. Hawaiian Electric, this one doesn't do anything for me. It's a bottom fish, had a big move up to, and maybe I should be excited, but the reason it's moving up is because there's a potential settlement agreed to on the big Maui fire and $4 billion. You could see where it came from before the fire. I got to believe there's going to be a lot of resistance into this gap. So that's a news driven. I already talked about intuitive surgical. I do like this a lot. We're in a tough market. Technically, it's less than 95 on high-low jump, so it's not extended. The relative strength and OBV look good. Great volume, 4 dots. I'm going to watch it. I just don't trust the market. If one of the other derivatives that I didn't mention when I talked about Bitcoin derivatives is Coinbase. So it's been kind of in a cup and a handle as it getting ready to break out, decent volume, breakout momentum. Um, Both bongos, all three bongos are green, not extended. Relative strength and OBV look good. The weekly looks good coming out of a flag pattern. So that's one that looks interesting. MicroStrategy, sort of the big boy in the place. It's not a miner. It's a holder of Bitcoins. And if Bitcoin is going to ever make that run to $100,000, then MicroStrategy is going to be right there with it. The only big concern I have with MicroStrategy, and I don't know if they've worked this out, is at some point I read that they were at the market pricing, they were priced 2x the value of their holdings. They also have a diminishing return technology software product that still creates some revenue and sometimes earnings as well. It's almost becomes take a dwindling tech company and turn it into a Bitcoin store and buyer and take that to buy Bitcoin with the hope that Bitcoin goes crazy. This is a stock that has had great performance when Bitcoin does well. Starbucks we looked at, it's a little bit of a bottom dweller here, but buying off a double bottom isn't horrible. AM is one of those MLPs, and somewhere we could probably pull up very quickly. Let me see if I can do it over here. Bear with me. I don't want to kill what I'm doing. Okay, good. I can probably pull up my trading view, put an AM into a midstream. Same basic chart as you'll see in wealth charts. But what I wanted to look at in here is dividend, 22 cents a quarter. That's 88 cents. So it's a 6-7% dividend. Very typical dividend in the 6 to 8% range for some of these MLPs. C.H. Robinson Worldwide, truckers had been weak. This thing had a big move up, and let's see what precipitated it. Looks like it's got earnings coming, and that always gets me nervous. Reinstates market perform, target 85. It's kind of already there. All right. Good RX is one that I like. It's a cheap stock. They announced a deal with a biosimilar, think generic injectable for Humira. Um, Cheaper, same product, savings to the end consumer. Nice run up here, breakout momentum. Again, you got earnings risk on a lot of these things. One that's earnings are out in a bank that I've talked about before is WAL. Now, it's too late probably to buy it, although it doesn't show it's extended by high jump. But here's one that uptrend, pullback, breakout. That's my pattern. And the time to buy was probably back in here. Here was the 4-dot move. It just moved 10 bucks since then, so the risk is a lot higher. Why would this have been my time to buy? Let me just put the horizontal line there so I don't lose the vertical line there. We'll stick it on 4 dots. The weekly bongo and daily bongo were green. It was not extended, and it broke above its moving average on both relative strength and OBV. And then I'll stop the next couple. Wolverine Worldwide. I'm a Michigan Wolverine, so I got to love this stock. Foot and apparel, run up, pulling back. At some point, I should have, could have, would have, should have, moved out of my way. And there's somewhere in there, there's probably a trend line that it took out. It's decent volume. This is one that's worth watching. And then one of my old friends, Axosome. I always thought this guy would be taken out. It's a specialty pharmacy play. Growing revenue, moving up higher. I kind of like that pattern, although I still think this is a takeout. Now, I think I'd like to look at downside. I still got a few minutes on how much time I wanted to spend. So let's just go to the weekend review, bearish. And let's go into retracements in a downtrend and look at a couple to see if we can't find things that look interesting to the downside. So these are pre-built scans. Let me talk a little bit about my tools on well charts. If you're interested, we just sold a lifetime for $9.97, and there'll be live education on July 25th, 2 to 3 hours. I'll show you how I use them, a little bit about how I trade options. We do that quarterly. You can get on my mailing list, my email list that I send out my thoughts to on a regular basis as well. I also will give you all the codes that I use, all the layouts that I use, and also will show you how to set up your scans so they look like mine. But This is a time, I think, to think of both long and short in the market. And so here's the one that comes right up to the top. And my God, I'm not really the best at picking heads and shoulders, but shoulder, head, shoulder. So probably somewhere here. Probably got a neckline in here. And we just had a breakdown from the 50 with a wealth signal, good volume, breakdown momentum to the downside coming out of the squeeze, the bongo flip, the relative strength and OBV have turned down. I mean, I love my tools. I can just open them up and start finding stocks that meet my criteria. This one I would say dropped too much. It's likely to bounce off that 200. Autoliv, I like if I was looking again from a potential shorting opportunity. Up, nope, it already dropped. I was say I liked it here because it pulled back in. Again, look at the minus 100. It's oversold, but one can go through NXPI. This has been such a great stock, but it just broke below the 50. Now, what would I optimally like to see? I would optimally like to see it run back up. Try that again. Drawing tools, freehand, freehand. I love to see it run up there and then turn down, and then somewhere right in this area, right there is where I would take the short. So we'll see if we get that. I'll leave that on. So I've looked at longs, I've looked at shorts. My little granddaughter's coming to get me. I think she wants to go swimming. So very quickly, let me pull up the contra ETFs and go through those, and then we're going to say goodbye. The contra ETFs are vehicles that go down when the underlying goes up. They go up when the underlying goes down. The dog will go up when the diamonds go down. If the diamonds were to roll over, the dog might be an instrument to look at. Why is it doing so poorly? Sorry for that. That's my granddaughter, and she's number one, so I'm not going to get mad. So the dog is low because the diamonds are strong. If the diamonds turn up, you might look there. SARK will go up when ARKK goes down. Um, SDS will go up when the S&P 500 goes down. Now, why are they all looking so bad? They're all looking bad because you had recent highs set on all of them, even TZA with the recent run by small caps. However, I can scan those and I will continue to watch them on a regular basis to see if I can't find any opportunity to start getting some buy signals in the contras, and there are none right now. So on that note, I'm going to thank you for bearing with me. Thank again to those that came to the Wealth 365 event on Friday. If you have questions about my tools, just reach out to me. I can get you in before the training event. And for those that buy my stuff, I'm always here to help you. Thanks a lot. We'll see you next week. And Molly, say goodbye to everybody. There you go, Molly. Say goodbye. Have a great rest of the week and next week. Thank you.